Today, we will be talking about bad investing habits you should leave behind if you want better returns. Whether you are new to investing or you're a seasoned investor, these 7 habits can really hurt your returns over time. So hopefully you don't have any of these bad habits, and if you do, now is the time to begin breaking them. And if you're new here, on this channel we talk about personal finance, investing, and business. So if that is something you want to learn about, consider subscribing. The first bad investing habit is trying to get rich overnight. Many people invest with the intention of making profit right away, and they think if they invest $1,000 today, they will have $10,000 tomorrow and then $100,000 in a few weeks. But that's not the way investing works, at least not over the long term. Many people claim they double their money every few months or even every year, and that might be true for a short period of time, but that will not be sustainable over the next 10 or 20 years. And if for whatever reason they are able to do that, then why aren't they the head of some major bank on Wall Street? The answer is because they are not able to achieve those returns over a long period of time. Even investors like Warren Buffett don't double their money every year, so don't fall into the trap thinking you will be able to do that. However, it is possible for you to invest in one stock, then it doubles in price next week. I mean, just look at what happened with Tesla stock not too long ago. If you got in at the right time, you might think you're a stock market genius, but more likely than not, it was luck, and you will not be able to perfectly time every stock you invest in. This also applies to thinking you can give your money to someone else and they will double it for you and make you rich. I don't want to say these are all scams, but the chances that someone will be able to make you rich and all you have to do is give them your money does not sound like the smartest thing to do. Look at it this way, if they actually do what they say they can, then why aren't they working with already rich people or big companies that can invest several million? The next bad investing habit you should avoid is jumping on bandwagons or having a herd mentality. The reason you want to avoid this is because you will end up making choices that you would not have made on your own. For example, if you don't normally invest in IPOs because you like the company to be on the stock exchange for a while before you invest so you have more data to look at, but all of your friends or family are talking about the Lyft IPO and how your cousin invested $5,000 and your uncle invested $4,000, most people in this situation will begin to question themselves and be afraid of missing out. So they decide they're also going to invest, and if it works out, then great for you. But in this case, if you invested in the Lyft IPO, you would have lost money. Then you have people watching these Wall Street guys on TV and they will follow their advice blindly without doing their own research. And just like in the last example, it could be that whatever stock they promote does go up in value and makes you money, but it can as easily go down in value. You must realize those people have their own motives for going on TV and talking about why everyone should go buy a certain stock. It could be their fund already owns the stock, so they go and promote it for their own benefit. It does not make sense for these people to go and promote a stock if they are in the middle of buying it, because once they go and talk about it on TV, that stock can go up in price, so they will end up paying more for it. And when you consider the amount of shares these funds buy, it can end up costing them hundreds of thousands more. I mean, you don't see Warren Buffett going on TV and telling you what stocks he is currently buying, and that's because it does not make sense to do that from a business perspective. It's okay to listen to what people are saying about other investments, but you shouldn't just jump on the bandwagon without doing your own research and coming to your own conclusion if it's a good investment or not. The third bad investing habit you should avoid is not investing for the long term. If you're only focused on what your investments are doing now and not what they can do over the long term, then you're going to become stressed whenever one of your investments decreases in value. You must realize that every single investment out there, whether it's stocks, real estate, or gold, is going to decrease in value at some point. This can be because of a slowdown in the economy or weak earnings during a specific period. The point is, you will never find an investment that only goes up in value. So when you are not investing for the long term, you will panic when your investment drops in value, and if you saw during a drop in the market, you will lock in any losses. Then some people trade stocks trying to avoid those that are going down in price and trying to buy those going up, but this is speculation, not investing. There are so many factors that determine the price at which stocks are trading, so it's impossible for anyone to know what all these factors are for every single stock. Then the way markets work now is that prices are updated within a fraction of a second. So by the time you hear that a company is going through a tough time because revenue is down, thousands of other people have also heard the news. So by the time you hear this news and you think about what you're going to do with your stock, the price will already be down, and if you sell at this point, you could be selling at a loss. Then when that company recovers and the stock begins to increase, it's going to take a while for you to realize this, and by the time you do, the stock will already be up. So now you miss the chance to get in early, and that's where most of your returns are made. If you pay attention to how stock prices change over time, you will see that the highest returns normally happen during a few days out of the year. So if you're always trading stocks, the chances that you miss these top days is extremely high. And just by missing the top 10 trading days, your returns will be much lower than someone who stayed invested over time. The fourth bad investing habit you should avoid is not having your own guidelines for what investments you will buy. Everyone has different investing goals, different levels of risk they are willing to take, and different resources, so you must develop your own rules for what you will invest in and how you will allocate your assets. If you do not like risk, then you can invest most of your money in assets that are considered to be safe, like index funds. But if you're okay with taking on more risk in exchange for higher returns, then you can invest in stocks that you research and pick. Then if you're 18 and just getting started with investing, you will most likely not have the resources to go and invest in commercial real estate. So in that case, you're better off investing in assets that have low barriers to entry like stocks. Also, by having your own guidelines for what investments you will consider, you will avoid investing in something that does not help you reach your goals over time. For example, if you are approached by someone to invest in real estate in a neighborhood that they claim is about to become very desirable, but is currently an area of town that no one goes near because of the violence, you will be able to make a better investment decision if you have clear guidelines for what you will invest in and what you won't. Let's say you normally invest in real estate, so that checks your first rule. But if your second rule is you only invest in areas with a proven record that people actually want to live there, then the investment opportunity would fail this rule. So at this point, you can decline to invest. By having your own guidelines and rules for what you will invest in and what you won't, you will be better off in the long term because the investments you make will benefit you and help you reach your goals. The fifth bad investing habit you should avoid is making investment decisions with your emotions and not using logic. This is probably one of the top bad habits people have, and many don't even realize they are making investment decisions with their emotions. Earlier, I talked about how you should avoid jumping on bandwagons or following trends blindly. Well, the reason people do this is fear of missing out. If many people are investing in a certain stock or a certain asset class, it's easy to feel like everyone else is doing the right thing and you're a fool for not investing. But avoid looking at things that way and instead use your investment guidelines to decide if you should invest or not. Then if you invested into a stock and your research told you it was a good company with a strong future, but one day the price drops for a reason that does not have anything to do with the core business, you could feel nervous and begin to question if you should sell. But those are your emotions talking and not your logic. What you should do is analyze if the core business is still doing good, and if it is, then you should consider buying more shares, not selling. Another great example of when you shouldn't use your emotions to make investment decisions is if you inherit a house or some other form of real estate and you decide not to sell because of the memories you have. Let's say your grandparents left you with the house they lived in, and this house is in a great area and you move into the house because it's cheaper to live there than continuing to rent. In this case, you're making a smart choice. Or even if you keep the house and don't move into it, but you rent it out and that house is providing you with cash flow every month, then that's a good choice because you're looking at it using numbers and logic, not emotions. However, if your grandparents left you with 5 acres and a small one-bedroom house in Montana, but you live in Texas and the only time you ever went to Montana was to visit them, and you decide to keep it because it was your grandparents, but you will never use it, then that is a bad choice because you're deciding to keep it out of emotions and not logic. The logical thing would be to sell that property and use the money to buy a rental closer to where you live or use that money for another investment. Even if you rented the land and the house, it wouldn't make sense because that property is located in Montana and you live in Texas, so managing that property will become a hassle. So when you are making investment choices, whether it's investing into something or deciding what to do with an investment you already own, you will be better off if you make that decision with logic and not emotions. The next investing habit you should avoid is over-diversification. This is one of those topics that many people have different opinions about. On one hand, you have people who say diversification is only for people who don't know what they are doing, and then other people say you should diversify across many asset classes and even over different countries. Both sides have valid points, but just like anything else, how much diversification you have depends on each person and what your goals are. For me, too much diversification comes in the form of investing in too many stocks. For example, if you are invested in 40 different stocks, I would say that's too much diversification because it will become hard to stay updated on the news and information of all 40 companies, and that increases the chances of making a bad investment. When investing in stocks, most of your allocation should be divided between 10 different stocks, give or take, and the reason is you will be able to better research each company and stay on top of your portfolio. And look at it this way, why would you invest into a stock that is number 30 on your list instead of investing more into one of your top 5 stocks? Another example of too much diversification is if you own 20 or 30 single-family rentals. At this point, it makes more sense to own a 10-unit building and maybe some 4-plex buildings, and that's because it will be much easier to manage 3 or 4 different properties and stay on top of any repairs. And the good thing about this is you still maintain diversification because you're not cutting back on the number of units you own, you're just putting more of those units on the same lot. Now the next bad investing habit you should avoid is not considering fees or taxes when making investment decisions. This is especially true with real estate because buying or selling property comes with large fees. If you're looking to invest into a flipped property, you will consider how much work the property needs and how much it will cost you, but you also need to consider the closing costs when you buy the property, the selling fees when you sell it, and any taxes you will have to pay, and if you fail to take this into account, you could lose money. Then if you invest in mutual funds and you're not paying attention to the fees you're paying, you could miss out on thousands of dollars over the next 20 or 30 years. The fees on mutual funds vary, but let's say you have $500,000 in your retirement account and you are invested into a fund that charges 1.5%. That means you are paying $7,500 every year just to be invested in that fund, and many mutual funds underperform the market over the long term. So in this case, you would be way better off investing into a low-cost index fund that only charges 0.04%. If you ignore these fees over time, your returns will be way less than someone who pays attention to the fees and saves wherever they can. So if you have any of these bad investing habits, now is the time to break them and begin your path to earning more. And with that being said, that is going to do it for this video. If you enjoyed watching or you found this information helpful, it would really help if you like and subscribe. Thanks for watching, and I will see you next time.